let's start from the other end of the spectrum. Let's start with a piece of software and let's say, where is it falling apart? Where do humans need to step back into the process to provide this level of support to borrowers, or to provide this level of explanation to lenders, or to manually move documents about? Which of these things can we automate further? Where are we building tech and where are we building a team? And as we figured those things out, over time, and built our platform out over time and built our team out over time, it's really evolved into this tech-enabled commercial financing team, where we have capital advisors and we have software engineers and designers and marketers all really working well together.
This is your daily real estate syndication show. I'm your host, Sam Rust. Joining us today is Tim Milazzo. Tim is the co-founder and CEO of StackSource, tech-enabled commercial financing platform that is one of the fastest growing commercial mortgage companies in the country. Their online platform gives real estate investors transparency into all their available financing sources, while the company's capital advisory team guides the process and helps structure the optimal capital stack. Tim, welcome to the show. Thanks for joining us today.
Sam, thanks so much for having me. This is awesome.
So I'm curious, I'm going to hit you with a little bit of a curveball here. How's the caffeine weaning going?
Oh man, you've done your interview research. I love it. So I completely quit coffee a few weeks ago. Back a few years ago, I didn't even get into coffee yet. When the pandemic happened and my wife got pregnant with twins at the same time, it was like game over for me as far as trying to keep up with the two existing little kids we had and two new ones added to the mix and working from home. So I became a really big caffeine addict just in the couple years span. And I thought, this is not what I want it to be for the longer term. So I'm off. I've been off for a few weeks and I'm doing okay.
Congratulations. Oh, that's awesome. What drove that decision? I'm always curious when somebody makes the decision to leave a habit like that behind. 90% of America, I feel is hooked on caffeine of some sort. But for you, why is this the right decision for you personally?
Well, I knew that, first of all, I wasn't really able to perform without having caffeine. And I noticed that on a day-to-day, hey, let me try to not drink it today. I would get a headache. I wouldn't be able to be in the zone as far as getting work done. And I didn't want to be beholden to that, to feel like my mental energy doesn't belong to me. It belongs to this thing in my cup. But I had a couple of colleagues that had already successfully moved away from caffeine in the past. So I asked them about their experience, and hiring one new colleague that was the second to not be a caffeine, partaker at all was all right, I'm doing this too.
Oh, that's fantastic. It's much the same for me. I've never gotten the bug for caffeine, but a lot of it, I don't want to get to that point where
for sure,
I'm not functional till I get my morning cup. And I know there's ways to safely imbibe, but still, it's just not worth it. I want my mind to be completely my own.
How about green tea?
I have not. So I'm not a big hot drink guy, which makes me weird and strange. And my wife, it's probably her biggest travail in our marriage is that I'm not a hot drinks person. So she's committed to converting me. We'll see how that goes.
Nice. Peer pressure.
Yeah, exactly. That'll happen. So as I was combing through your background, graduated college back 13 years ago or so, I noticed that you did an internship with CBRE. Is that what got you kind of into commercial real estate a little bit? What precipitated that internship? And I'm sure there's a link from that internship to StackSource. Could you just elaborate on that chain of events for us?
Yeah, there's a bit of an indirect link from me interning at CBRE in New York City years ago versus starting StackSource a few years ago. But the way I got that internship, Sam, I'll come clean. My dad was a managing director for a big real estate services firm in New York that was acquired by CBRE. And so the CBRE actually had no New York presence until, I guess, the 90s. They were a growing company on the West Coast and in Texas. And today they are, I don't know if it's them or JLL that's in the lead for being they're the two largest commercial real estate services firms in the world. So they both have a global presence and, 10,000 plus employees doing all sorts of things from leasing and facilities management to things like selling buildings and capital markets. But my dad still had some connections in that office, and I was studying finance and I wasn't sure what I was going to do that summer. So I admit that it was a kind of a family call from my father to a broker over there saying, hey, do you need some summer help? And they had an internship program. That summer, I did a lot of administrative work. It was kind of cool to see the buildings in New York. What's really cool and what I really attribute to that summer was getting exposure via like some little internship field trips to like the actual real estate developers that had put towers up in New York City, because I thought, wow, here are people really changing the map. I mean, physically, literally, like they're changing the landscape. They're changing the landscape of like one of the greatest cities in the world. And that takes vision. It takes planning. It takes the right people. It takes execution. That's so cool. And I loved that part of the real estate industry. But I didn't think that I would be a full-time real estate professional, because coming out of school that next year, I did not pursue immediately a career in real estate.
Yeah. And you went more towards the tech side, and there's a lot of people that get to tech and never leave. What was the catalyst for you to leave Google, Facebook behind and start StackSource? I mean, obviously you've got some real estate in your blood, so I'm sure that helped.
Yeah, I loved my time working at big tech companies. So I was in New York for a couple of Silicon Valley, tech giants, and we were working in advertising technology. But the thing that got me turned back on to real estate. So if that internship showed me, hey, this is there's cool outputs from this industry and there are cool people, I didn't think I wanted to be in the real estate services because that seemed old school to me. When I saw the opportunity in real estate tech to take like the ideas of what's happening in the real estate industry and the vision and making things a reality, but if there was a way to do real estate services and bring to the industry like a different harnessing of information and tech and software, that's really what turned me on. And the way I discovered that, it was, I had a couple of friends that were in the industry, and we went together to a real estate tech meetup. I was like the tech guy that was like working at one of these big tech companies, and they were a couple of these guys like interested in like real estate investments and like buying their first buildings. And we went to a real estate tech meetup, and at least I'll speak for myself. My eyes were open to, hey, the possibilities and what's going to happen in real estate tech, the harnessing of information, being able to collaborate online and instantly, and everything that can be done with software. This intersection is going to bear a lot of fruit, and there's a lot of opportunities to do it.
No. Oh, that's super cool. So I first heard of StackSource back kind of at the beginning of my real estate journey. I was trying to remember, I think it's late 2017 or early 2018 was the first time I heard you on a different podcast. And so I've been following StackSource from afar. And when you guys started, at least when I browsed your website back in the day, you guys were focused more on small balance loans. I think those were maybe a little bit easier to automate, kind of the lower hanging fruit. There's a lot of inefficiencies in the small loan market. How have you guys iterated over the last couple of years, and what growth is on the horizon in 2022 for StackSource?
Good question, Sam. So if you heard us in late 2017, early 2018, we probably had just gotten like our first couple of little loans done on the platform. The team was me and a couple of software engineers, and we had a prototype that was like duct taped together, in building this platform. And Our first of all, the vision for StackSource has been the same since the day we started, which is bringing transparency to commercial real estate finance. Okay. So if you are buying a home, and now that's residential real estate finance, if you're buying a home, either as an investment or just to live in as a consumer, you get a residential mortgage. That space is dominated by tech-enabled players today. Rocket Mortgage has surpassed now 10% market share of the residential mortgage market, which is an enormous amount for the thousands and thousands of companies, banks and credit unions and residential mortgage companies that would like to be your guide to residential real estate finance. For one company that's ahead of technology to take 10% market share is massive. You step into commercial mortgages and commercial finance, and you find that like you actually are stepping into the past by several years and saying, well, where are the instant quotes? Where's the online digital closing checklist? Where is why is it so hard and so many manual steps to figure out what interest rate can I get? What type of loan can I get? How many dollars do I need to close? I mean, these are questions that you might assume if you've only bought a house as a consumer that are easy to answer, but they're actually super hard to answer in commercial. And we had this vision of making it really easy and transparent to answer those questions. How many dollars? What interest rate, what type of financing do I qualify for if I buy this property or if I refinance it? And that was like entirely like opaque as we started. And even today, most of the market share is like big traditional commercial mortgage brokerages. But in the beginning, it was like we were software engineers and technologists saying, how much can we automate this process? Which type of loans can be automated more? Even on those ones that are quote unquote more automated, how much service do we need to provide? And it allowed us to, instead of taking the existing commercial mortgage brokerage process and saying, well, how do we tech enable that? That's a really hard way to go about innovation, is to take like an existing model and like stick technology in. So where does it fit? I mean, you already filled up your process with like humans do this and humans do that and humans do this. Let's start from the other end of the spectrum. Let's start with a piece of software and let's say, where is it falling apart? Where do humans need to step back into the process to provide this level of support to borrowers, or to provide this level of explanation to lenders, or to manually move documents around? Which of these things can we automate further? Where are we building tech and where are we building a team? And as we figured those things out, over time, and built our platform out over time and built our team out over time, it's really evolved into this tech-enabled commercial financing team, where we have capital advisors and we have software engineers and designers and marketers all really working well together. And that's brought us up into the mid-market, where we're getting larger transactions done. And it's even most recently like, we have these clients that trust us with, find me the best available loan on the market. Well, if your tech and your team was able to help me find this awesome loan, and I knew exactly what I could get and how I could get it closed, are there other forms of capital that I might qualify for elsewhere in the capital stack? So we actually recently closed our first joint debt and equity assignment on the platform. Somebody was buying a large apartment complex in Texas for $53 million. And we brought 85% of the capital stack through debt and equity through one experience. And that's something we're looking to do more of, is go up and down the capital stack, really automate as much of simple debt placement as possible, have a great team that provides great structuring and negotiation, skills for the whole capital stack as well.
Yeah. So I'm trying to picture you guys starting off, and it's almost a chicken and the egg situation, because you need to have customers that are going to drive demand for loans, but you also have a whole nother set of clients on the loan side. You need lenders that are willing to work with your platform. How did you attack that problem then, and how are you addressing that problem now? Because it's a whole different ballgame originating loans between 1 to 5 million and 30 to 60 million. Like, you're dealing with very different entities. The good old boy network is a lot stronger the bigger you get, and tends to be older and less tech friendly. Maybe that's a gross oversimplification, but how have you guys solved that then, and how are you solving it now?
Yeah, well, so then if you were a borrower coming to some prototype of StackSource.com with a really simple website and putting in a loan request, you had to be matched with some lenders for that process to go anywhere. And so we needed to get some lenders on the platform for like a day one launch of the platform. And so that was like me calling, 100 plus lenders, some of which I knew, most of which I didn't know, and saying, hey, we're going to have this deal flow, and, would you like to be on our platform? We learned that lenders, what they really like is good deal flow, rather than talking about the ideas of technology and how they're going to be more efficient. So I learned really quickly, just like wait until we have a potential client with a loan that they might want, or something like that, before calling the lenders. Today, it's much different on the lender side, because yes, we have a capital markets team that like manages like relationships with our capital partners. We have 1,000 capital partners on the platform, banks and credit unions and life insurance companies and debt funds. And we don't need to do a whole lot of like calling and business development to capital markets, except to fill in like very specialized gaps sometimes. So the lender side, credibility, super important. It took some just like elbow grease to break in and have enough lenders on the platform for day one, and then hopefully get a network effect to take over. So now, borrower side, are any borrowers going to show up? Do they show up today? How do we get to them? And to your point, like somebody that's looking for a $50 million loan, are they Googling online provider of commercial mortgages? No, they're probably not. We do get people that are like working on their first couple of multifamily deals that will like find us online. We've started doing content marketing. So that's something that can dip into the mid-market, which is, hey, here's a 4-minute read about what's happening in the debt capital markets this month or something, or here's a primer on what it really takes to get a non-recourse loan. And so we do content marketing that attracts borrowers and certainly attracts new borrowers, and also attracts some mid-market. But mid-market is absolutely relationship based. Our capital advisors form relationships with borrowers to bring them back for a second, third loan if they have found us online, to really instill trust in the process, give them someone they can talk to that's going to add value in their process. So yeah, there's totally a relationship aspect in that middle market. And part of it has been the great growth of our capital advisory team, which is now up to 16 individuals across the country that have all been lenders and mortgage brokers, in their own right in the past.
Vertical Street Ventures is excited to announce their first annual national conference, Financially Free in 3, a conference for real estate investors. This is a 2-day event happening on June the 4th and 5th in Scottsdale, Arizona. At this conference, you will hear from experts on how to leave your day job and become a full-time real estate investor. Understand the tax-efficient strategies to keep more of what you earn. Learn how to buy real estate assets that create passive income for you. Meet hundreds of like-minded people and the unique opportunity to take a bus tour around large and small multifamily properties to learn how these investments are operated. There will be world-class speakers and industry experts, including Hunter Thompson, Michael Becker, Paul Peebles, Amanda Hahn, and more. Go to vsvcon.com to grab your ticket. Make the decision to get out from the sidelines and learn about new opportunities to build your wealth. This will be the most critical investment you'll ever make in yourself. Again, visit vsvcon.com today.
Oh, that's fantastic. One of the things that fascinates me about the growth of small business, it starts with an idea of an entrepreneur, usually a visionary, who's like, hey, we're going to go change the corner of the world this way. And that's what happened with StackSource, right? It's a couple of software developers. You guys are putting this together. But now you're over 30 people in your team. You've got multiple departments. You just hired your first marketing director. How have you managed your own role and the evolution of the CEO? Because you went from the bottle washer to now it's a legitimate organization with departments and heads and all that comes with that. Has there been any inflection points for you personally along the way?
Oh, multiple, Sam. So first of all, anybody's an entrepreneur when they have an idea, but they really try to go after it. Like that makes you an entrepreneur. If you're having an idea and talking about it, doesn't make you an entrepreneur. Like the second you actually try to make that thing real, and it doesn't need to be your full-time job. Like that may be a misconception right on, is like, it has to be your full-time job for you to be an entrepreneur. No. If you have a side hustle, you have an idea and you're going after it, as long as you're taking real action toward it, that makes you an entrepreneur. So I had the first inflection point of like leaving my salary at like a big tech company to be a full-time entrepreneur with StackSource. Like that was a huge inflection point. Then you realize, oh wait, like what I want to achieve needs more resources. Then you have to mount the inflection. But like some of these are all the next plateau you have to get to. Like you see one, you're climbing and you get to a certain plateau and you have to get to the next one. So that next plateau is like, I need to get the resources and the team to make this real. And hiring the first few people that are crazy enough to work at like a nothing stage startup is a little bit different than recruiting. Now the next stage is like, these are people that want like a legitimate, like, they're not going to be co-founders. They're not going to get a huge amount of equity, though they might get some equity, but they want like a legitimate salary and benefits, and they want something out of the company that's a different level of team building. And that's another plateau. So being able to hire for, hey, you actually have a job description here and here's what it is. And, we're going to give you quarterly goals and you're going to get measured and get bonuses. Like that's a whole other plateau of like management. And so you have to then mount that management plateau. And then, finally, the plateau I've been working on most recently is, well, now there are enough people at the company that I can't manage them all. So I'm going to have to lead managers. And like, we need a new head of sales, and we need to hire that marketing director because I can't do all the marketing and manage all the people. So it's like this process of letting go of what you were doing last and abstracting it one more level. Well, instead of doing the marketing, manage somebody that does the marketing, or instead of managing the people doing the sales, manage a person that overlooks the entire sales organization. So that leadership thing, you have to have great mentors. And if you don't, you literally have to kind of go out there and pay for it. I think I have an executive coach. I'm part of a paid monthly CEO roundtable group where we go and like I learn and I glean from other CEOs of what they're doing. And we talk about like, making sure that we're doing the business in the right way and striving for the right purpose. So I'm part of a CEO group through the C12 forum, which is the one that I do. So I pay for these things because I want to learn them even faster and not just through mentors, though mentors have been a huge part of it as well.
Oh, that's fantastic. I'm a C12 member as well.
Aha.
That's been a significant part of my development over the last year or so, is just constantly looking to that horizon and then surrounding yourself with people who are also marching on said horizon and just borrowing. I mean, there's really nothing new under the sun. Yes, technology is always iterating, but fundamentally, when it comes to leading an organization and leading people, there's just no substitute for the time and then the expertise of those who've gone before and done it well.
Yeah, absolutely. You have to, I mean, if you're not investing in yourself and your skills, I mean, you're going to provide leadership. It just may not be good leadership.
Yeah, that's very well said. So I'm curious, we talked about this idea of a horizon or the next plateau. There's a lot of people that get stuck along the way. And it could be, a lot of people in our audience are syndicators. Some of them own small businesses and they're investors, but we're talking more about small business than we are real estate here for a second.
Yeah.
How have you been able to raise your eyes to that next plateau? What drives you forward? What things have you intentionally put in your path? You mentioned C12 and executive coaching and some of those things, but I'm sure there's other things you could point to as well.
Yeah, well, classic resources, books, right? I love podcasts. As a matter of fact, I'm subscribed to too many and like it would take more than the hours in the day to listen to them. So that's like, it's not a great strategy, but I try to catch up with like the right podcasts here and there. So there are good resources out there that are like single player mode. So like the CEO forum, that's a multiplayer thing. Like you need other people to be there and engaged. Same thing with an executive coach. That's one other person. That's like a one-on-one. There are single player mode, like do at your own pace. That's books, that's podcasts, that's articles. I'll say there are a couple of hurdles too that will hold you back from reaching those next plateaus or even knowing what plateau to go after next. Like one of the hurdles can be fear, right? Can I succeed at that level? Do I know what I'm doing? It could be fear of failure. It could be fear of getting good feedback. It could be an ego thing. Fear and ego may go hand in hand sometimes, where maybe you don't want to know what you're failing at, or maybe you don't want to know what you need to improve on. So there are things that can stand in your way, but there are also a bunch of these single player mode to educate yourself. And it's all an investment, right? It's all an investment of time. And what do you hope to get out of it? For me, I've invested heavily. I'm going to continue to invest at this stage in like education, reading the right books, listening to the right things. You can't do it entirely alone, but I think you can do some single player mode learning in addition to some, group learning. And maybe there are, unicorns out there that don't need any of this to become like billionaires, but I think the average person does.
Yeah. And I think you see that with, Warren Buffett's a famous example, but just the amount of material that he would consume is crazy. He'd spend most of his time reading S1s and different industry publications.
Sure.
After 60 years of investing, he's got a fairly substantial pile. How do you curate that single player mode? Because that's a constant struggle for a lot of people, myself included. It's like, I want to be reading good books. My goal this year is to read 75 books, but finding quality books to read through can be a little bit of a challenge. How do you solve that problem?
Oh man. Well, ratings is part of it. I use, on the books one, I use goodreads.com, which is, I think, the biggest book reading social network. If there's a bigger one, I would be surprised. And so I probably have a list of, 150 like on my want to read list. I find that want to read list is growing faster than it's shrinking. Like I'm adding more books than, and I'm not at the 75 level that you're at, Sam, because there's a little trade-off with like spending time with my younger kids and running the business. But I do read books as well. And so what I've been doing for the last few is I have my books of 150 that I want to read. I already know that I want to read those ones. So I sort my list by the average user review. And okay, well, here are ones that other people have agreed were a worthy read. Because just because the topic is interesting doesn't mean it's like a great book execution wise either. So I'm kind of trusting a little bit, the wisdom of the crowd. I actually still find that that's still difficult with podcasts, actually. And I wonder for you as a podcast host, like, Apple, reviews, I think, are still the gold standard, like how many 5-star Apple reviews you have on your podcast. But I'm surprised, like, that's not nearly as sophisticated as like people leaving reviews on books and like average star reviews. It seems like it's still more significant for TV shows, for books. Like, it still seems like podcasts are still a little bit more difficult.
For some reason, I think it's difficult to get enough ratings. I mean, you have your Joe Rogans, your Tim Ferrisses, some of those podcasts that have tremendous reach, but a lot of times people are listening to a podcast, but they're not interacting with the review side, whether it's Spotify or Apple or whatever player you're using. And I think it almost disproportionately lends itself to people who are unhappy. And so you end up not having as accurate a rating system, in part because you just don't have the same level of people interacting. Like Goodreads, which I also use, we're all interested in curating our own library, and it matters, and it pops right up. I use Kindle a lot, and so it'll pop right up at the end of a book. It's like, it's very easy for me. It's a little bit different on the podcast realm. Any off the beaten trail podcasts that you've found yourself really enjoying over the last 6 months?
Well, I'd have to bring up the list to give you a decent answer at that. But in addition to like real estate, I listen to like business podcasts and entrepreneurship, like I was about to say Joe Fairless on the real estate side, but Guy Raz on the entrepreneurship side. I also listen to some tech podcasts. So like This Week in Startups, and that's not off the beaten track, but it might be for real estate people to like listen to what's going on in, Silicon Valley with like VCs and like big tech companies. And so I clue into enough of that like I have a little bit of a pulse, though I try not to spend like too much time in that stuff because I am interested in like other technologies, but that's not necessarily going to serve what I'm trying to do in StackSource. But I need to be informed enough, but I could go down a rabbit hole where that becomes like too much of what I'm consuming, no longer focused on like what I need to be doing for StackSource. So that would be like a rabbit trail that I could go way too deep in. But once in a while, I'll listen to podcasts that have nothing to do with tech or real estate or business. And those will be some spiritual podcasts, but also just some like for enjoyment. There's a 99% Invisible podcast that's about design. And I'm awful at design, Sam. I'm terrible at design, but I appreciate good design. And it dives into stories of good design. And the point of the word 99 or the title 99% invisible is because good design is 99% invisible. You don't notice much of good design. You only notice the parts they want you to see. So I'm fascinated by that stuff, even though I can't do it.
Yeah, that's super cool. Well, we'd be remiss if we let the CEO of StackSource leave our podcast without at least touching on the volatility in the debt markets. We've seen borrowing costs shoot through the roof as consumers of that product, and I'm sure you're dealing with that as well. The Fed has talked about raising rates to the end of the year. There's talk they may raise by 50 bips, both in May and June. We're in a period of volatility, unlike we've seen for a while. I mean, COVID was certainly volatile in that everything froze, but we're in a different environment now. Where do you see opportunity in the debt market today?
So, and this is an oversimplification, but rates are up like 70 basis points today in borrowing costs versus where they were January 1st. So you're right to say like this is the first like volatile interest rate environment that we've had in years. We've had historical lows. Now, 70% above January 1st still keeps us at a historical scale. Like when we look at the last couple of decades or last few decades, they're still pretty low rates. Cap rates are very low. Interest rates are still fairly low. So like if you have something to finance right now, an acquisition or a refinance or even construction money is still there. We haven't heard from anyone yet. And this certainly is subject to change based on even when you're listening to this podcast. If it's a few months from now, you may be like, hey, Tim, you're crazy. As far as like it's about to be April 2022, we haven't had any capital providers that have said, hey, we're out. Just like count us out for now while we watch with the market. None of them have said that because there's still a lot of money in liquidity. Now, there could be a liquidity crunch if a couple of things happen. One is if we enter like a swift recession, there could be a liquidity crunch. Two is if like interest rates continue to rise substantially from here in like the coming quarters, there might be a liquidity crunch, but that hasn't hit. And so financing is there and there for full leverage. And even if it's 70 basis points higher, so like 0.7% higher within your borrowing cost, we're talking about rates like being from mid 3s to low 4s. Like they're in the low 4s right now for many lending products for permanent loans. That's true for CMBS. It's true for, stabilized multifamily assets. That's true for industrial and like grocery anchored retail and a lot of commercial real estate. You can still get money in the low to mid 4% interest rate range. And that's not a crazy interest rate. We're not at 7%. Yes, it's higher than it was, but to get a 4.25% interest rate and, a full 75% leverage on an asset shouldn't kill like tons of underwritings unless your cap rates are not being adjusted, a little bit. So we have to see what happens with cap rates over the coming months. But if you're planning to refinance, it probably hasn't killed your refinance. It's still a good time to lock into a 10-year fixed. But that story could be different 6 months from now. It absolutely could. That story could be different 4 months from now. As of right now, you can still lock into a 10-year fixed, and it's a really reasonable interest rate, historically speaking.
I remember the second deal we did, we closed in 2019. We locked 7-year fixed money at 4% flat and thought we had swindled everybody. And then, we proceeded to lose money on that for a while. And now we're getting ready to sell that asset and the prepay penalty is going away because interest rates are back up. But
right.
From a historical perspective, you're correct. And I think something that as syndicators and folks who are interested in commercial real estate, we talk a lot about the relationship of cap rates to the 10-year treasury. But there's a lot of interesting data that says that while that's broadly indicative, what's maybe more indicative in the short term, in like 3 to 6 month windows, is liquidity in the market. How much capital is interested in chasing deals, both from the equity side and the debt side. And a lot of those measures are at all-time highs. So I do think it's a buyer beware market in some aspects. Things are changing. If they change significantly enough, yes, interest rates will drive cap rates, no doubt about it. But there's a lot of strength in the market as well. And while there's this much liquidity, I don't think we're going to see cap rates move as much as some canaries in the coal mine would have you believe.
Yeah, we'll see if the liquidity goes away. I'm in agreement with you. I think we're both going to be watching the same thing. If the liquidity starts to shrink. And the other thing is not just the Federal Reserve moving the benchmark interest rate, which is the most famous thing they do. And that's what they've done for 100 years. The more important aspect of this is not just going to be, are interest rates up another 50 bips? Is the Federal Reserve buying less treasury bills? And because they bought a lot. They've bought a lot during the great financial crisis, but they bought even more during COVID, like to historical scales. So we're going to see what impacts that has on liquidity, even more than the interest rates.
Yeah. A lot of folks will see it abbreviated as QE or quantitative easing, and like that's going to be a needle mover that doesn't hit the headlines quite as much as the 10-year.
Right.
Fantastic. Well, Tim, it's been a pleasure to have you. As you're leaving, where can folks reach out to you, learn more about what StackSource is doing, and if they're interested, engage you guys?
Sure. Well, our website's really simple, stacksource.com. So think about sourcing the capital stack, stacksource.com. If you search Tim Milazzo on LinkedIn, Facebook, Twitter, I'm usually the first one. But if anyone would like to reach me directly, my email address is tim@stacksource.com. So again, simple. Feel free to reach out to me if you've got questions, want to talk capital markets, want to learn about roles at StackSource.
Fantastic. Well, thank you, Tim. Thank you to our listeners for joining. This has been another episode of the Real Estate Syndication Show. I'm your host, Sam Rust, signing off.
Thank you for being a loyal listener of the show. Please subscribe and share it with your friends. We want to help you become the passive investor you've always wanted to become, but also the operator you've always wanted to become. We want to be the #1 resource for your real estate investing journey. But go to lifebridgecapital.com where you can start investing in real estate today.